Hello and welcome to the monthly recap. This is for the month ending today, January 31st, 2025. All right, so I'm not going to say it this time. It was not a busy week from the market's perspective. It was an eventful week from the market's perspective, but it wasn't necessarily busy. There wasn't like a glut of data. There wasn't a Fed meeting that resulted in a Fed rate cut or any of those things. So it was an eventful month, sure, but it wasn't particularly busy from market data, that kind of thing. So let's take a look at what we got. So new administration. How did the markets react? I'm going to be talking primarily about that and staying as apolitical as I possibly can, as always. Um, Inflation had a pretty good month. Talk about that. Jobs had a good month? Question mark. Like Ron Burgundy. I'm Ron Burgundy. So jobs had a good month as well, kind of. We're going to be looking at that and the differences between BLS and ADP. Fed meeting. I already talked about it very briefly, but there was no rate cut, but there was some additional guidance from the Fed. We're going to be taking a look at all of that. And then mortgage rates. They did improve slightly on the month from around 7% on a 30-year fix. First-time home buyer making less than 120% of the area median income, kind of that ideal scenario. They improved down to about 6.875. So slight improvement there. Obviously, it was the new year. Obviously, Martin Luther King Jr. Day, also the Lunar New Year as well. Let's take a look at all this. So, new administration, what was the market reaction? So, there was a lot of anxiety in the buildup, in the lead up to the new administration. Now, as you know, I try to stay as apolitical as I possibly can. I try to stick to the facts, remove my opinions from it. I've actually had just a couple people reach out and say, "So, where are you on the political spectrum?" And the fact that people are asking that is exactly what I'm looking for. That means I'm doing a good job of threading that needle and not revealing my own personal beliefs. Take that out of the equation. I'm just focusing on the facts. So, let's take a look. So, in the lead up to, again, the new administration, there was a lot of market reaction, a lot of volatility in the markets. There was a lot of questions and concerns, primarily because it was mentioned, hey, look, on day one, we're going to impose 25% tariffs on Canada, 25% tariffs on Mexico, and 10% on China. The markets wouldn't like that. It would be inflationary in nature. There's a lot of debate about how inflationary in nature, but everybody agrees it would indeed be inflationary in nature. Well, bonds don't like inflation, right? Mortgage-backed securities are a type of bond, a type of promise to pay. When you sign a mortgage, you sign a promise to pay, right? Well, inflation eats into that fixed rate of return that a 30-year fixed mortgage would offer. So that's why inflation is the arch nemesis of bonds, right? That's why inflation is the arch nemesis of mortgage rates. Okay, so inflation would be bad for mortgage rates. It'll also be kind of bad for the stock market because the less money people have, the less money people have to spend. And the stock market is purely based on how much people have to spend, right? So inflation would be bad for all the markets, stock market, bond market, all of those. Okay, so within the first 24 hours of the oath of office, there was almost 50 executive actions signed, 26 of which were executive orders. Both those numbers are very high compared to previous years. Missing from the list were the 25% tariffs on Canada and Mexico and 10% on China. The markets heard that. They took a deep breath, sigh of relief. They're like, great, great, great. This is fantastic news. Now, I mentioned in one of my other updates, it might have been a weekly update, that Scott Bessent was the Treasury Secretary pick. And he was seen as a very moderate pick. He was seen as a kind of calming head, somebody that's going to, he's donated to liberal candidates and Republican candidates. He's got a lot of real world experience. He's hedge fund manager. He's got a lot of experience in the market. So he was seen as a very moderate pick, somebody that would use potentially tariffs as a leverage point rather than as something that's actually going to be done, something that's actually going to be enacted. So far, great. That's been true. Markets breathed a sigh of relief, and the markets had a pretty solid week because of that. The following weekend, however, tariffs were threatened against Colombia. There was disagreement over deportation of immigrants, and the new administration basically told Colombia, hey, we're going to put tariffs in place. Colombia walked it back, and for better or worse, it worked. And when you give a mouse a cookie, it's going to want a glass of milk. So the point there is, this is not the last you're going to hear of this. You're going to hear a lot about tariffs this year, probably so much that you're going to get sick of it if you're not already. So expect this to be a recurring theme throughout the year, throughout the administration as a whole. It worked the first time. Why wouldn't it work again? We're going to continue to hear more and more about this. The administration also said, hey, look, just because we didn't do it on day one doesn't mean we're not going to do it. So they're still at it. It's going to be very interesting to see what happens there. So latest inflation data. Like I said, inflation actually had a pretty solid month. Okay, not a blockbuster, not a wonderful month, but a pretty solid month. So starting with producer price index. Okay, producer price index is inflation on the wholesale level. PPI, inflation as businesses feel it. They collect those raw goods, they make stuff out of those goods, they then resell those goods. Well, it's how much is the cost of the stuff that's coming in that they then repackage and sell. Okay. The idea being producer price index, PPI, could be a leading indicator for consumer level inflation. If a business gets charged less money for goods, they could pass that savings along to the consumer. Could is the key word. They don't have to, right? They could simply shrink their margins, grow their margins. Like there's a lot of different ways they can deal with it. So PPI, for a lot of good reasons, gets the least amount of respect. Okay. The headline increased 0.2% to 3.3% from a year ago. The core, which the core rate is volatile food and energy removed from that equation. When you remove the cost of eggs and chicken and gasoline prices, what is the actual inflation look like? Now, the Fed cares much more about core inflation. They know that they can't control avian flu and whether or not it costs eggs to increase. They know they can't control the price of oil prices necessarily. So focus on what they can control, which is the price of everything else. Okay. So core was flat at 0% in December. It's at 3.5% year over year. Consumer price index, CPI. That is inflation as you and I, us consumers, feel it. Okay. The headline increased 0.4% from 2.7 to 2.9. Not great, but the Fed doesn't really care about the headline number. They care about the core number. And the core number came in pretty good. It increased only 0.2% year over year. It decreased from 3.3 to 3.2. Markets were very happy with that number. There was a little bit of a market rally that week. Personal consumption expenditures, the Fed's all-time favorite metric of inflation. Okay, PCE, the Fed's all-time favorite measure of inflation. That came out quite literally today. Headline went from 2.4 to 2.6. Not great, but the Fed doesn't care about the headline. They care about the core, and the core remains stable at 2.8%. The Fed wants core PCE to get down to 2%. Okay, so that's the Fed's target. They've also acknowledged, look, we're not going to hit it in 2024 or 2025 rather. We're not going to hit it likely in 2026. It might not be until 2027 until we finally get to that number. So they are acknowledging that it's going to take longer to get where they want to get to, which is great. It's nice to see a reasonable Fed in place that's understanding of the market conditions. Now, when we look at year-over-year numbers, yes, today's numbers matter. They very much do. But also what's important is the numbers from a year ago, okay? And when we add one report, we lose one report. Okay, so when you look at the upcoming replacement numbers, hey, when we look at February's, it's pretty calm. But then when we look at March and April, those are some higher numbers. It's entirely possible we continue to see some more moderation of inflation over the next few months, which is great news. Jobs numbers. Good jobs report? Question mark. There's Bureau of Labor Statistics, and then there's the ADP employment report. So ADP is one of the largest payroll companies in the entire country. They have their fingers on the pulse. They know exactly what's going on. Bureau of Labor Statistics does a lot of modeling, a lot of analysis, a lot of what they call birth-death models, where they say how many businesses were created and how many businesses were lost. Well, are all those businesses real businesses? Are they shell companies? There's a lot of question marks around it. Bureau of Labor Statistics has the largest margin of error of any company I've ever seen. It is very common for them to come out with these numbers and then revise them months or even years later by 25, sometimes 50%. So take it with a grain of salt, even though the Fed does not take it with a grain of salt. Okay. December jobs market report showed 256,000 job gains. Expectations were for 160,000. So blew those expectations out of the water, just completely crushed them. The unemployment rate also decreased from 4.2 to 4.1%. Bureau of Labor Statistics report is important only insofar as the Fed cares about it. The Fed looks at it, the Fed cares more about it than they care about any of the other employment reports. Kind of crazy, especially considering their wide margin of error. There's been a number of market experts that have actually reached out to the new administration and said, hey, look, can we please change how we're going about doing this analysis, what numbers we're relying on? Because the markets react to this. It's really, really important. And as important as it is, the numbers have not been very reliable. It's been a constant issue for the last couple of years even. ADP showed a very different report. They showed only 122,000 jobs being created. Expectations were for 140,000. Then when you look at some of the underlying data, you saw job stayers, so those who stay on their jobs, and then job changers, those who change their jobs. Job stayers have seen their income increase 4.6% from a year ago. Not bad. But that's down from 4.8% just last month when we got that report. Why is that important? Well, if you remember COVID-19, who could forget? I can't believe how long ago it's been. It's amazing. Anyways, COVID-19 happened, right? A lot of people lost their jobs. It was really, really rough. But then once the market stabilized, it was a very aggressive labor market. People started spending money like it was end of days. and because of that, people needed employees. And they just started throwing money at people. So we saw these numbers considerably higher when the employment market was really strong. Why? Well, for job stayers, employers had to incentivize their employees to stay in town because they knew they had more options out there, right? And if you're a job changer, right, employers were just throwing money to attract new talent. So as these numbers have come down, we've seen that the labor market has indeed softened. There's really no question about it. Employers only have to incentivize people to stay if they're worried about them leaving. And they only worry about them leaving if there's other opportunities available. Well, both those numbers are coming down, and they're coming down pretty significantly, pretty drastically from where they were just a couple of years ago. So keep an eye on that as well. It is probably one of the most reliable, probably underlying benchmarks to kind of base the strength of the jobs market on. Like, who knows better than your HR department how competitive the labor market is, right? All right. Fed meeting schedule. Fed just wrapped up their meeting 2 days ago. They did not cut rates. They did not hike rates. They left them stable. Talk about their commentary on the next slide. There's no Fed meeting in February. There is a big one in March. Now, these ones in bold, so March, June, September, and December, these are meetings associated with the summary of economic projections. What does that mean? That is when the Fed comes out with the dot plot that shows how they think rates are going to improve. They also come out with their GDP expectations, their employment rate, unemployment rate expectations. They come out with their future guidance for inflation, all of that. It's also their best platform to make a move on rates. That doesn't mean that they're not going to cut rates on these summary of economic projection meetings, but whenever given the chance, they like to be able to explain their work. And the summary of economic projections meetings gives them an opportunity to explain their work, not just do a rate move, but also explain their work, right? So it's going to be very, very interesting. The Fed meeting itself, they left rates unchanged, okay? No surprise there. Everybody knew that going in, that they were going to leave rates unchanged. The Fed did mention that the labor market is showing strength. Clearly, they're looking at BLS, and clearly they're not looking at ADP. And that inflation is still elevated. It's still elevated, but it's stabilizing. It's decreasing in some arenas. That's actually pretty good news on the inflation front. Again, yes, it is still elevated. The Fed's acknowledged that. They think it's going to be another year, possibly two, before they hit that 2% target that they're looking for. Jerome Powell did comment that the Fed funds rate is meaningfully above neutral. That is Fed speak for, we have more work to do. We will be cutting rates, okay? There's no talk of them hiking rates. That hasn't even been whispered or uttered or any of that, okay? Meaningfully above neutral. We will be cutting rates in the future. That's really all that they're trying to say there is, don't worry, we didn't cut rates this time, but there are future rate cuts on the horizon. How soon and how much, it's going to depend on the jobs and inflation data. If inflation comes in much cooler, the Fed's going to feel empowered to start cutting rates a little bit more aggressively. If the jobs market starts to falter, if the unemployment rate starts to tick up, if the employment market starts to really soften, and not just soften, but it has to show up in the BLS numbers, unfortunately, then the Fed's going to feel more empowered to start cutting rates a little bit more aggressively. So looking ahead, no Fed meeting, like I said, in February. Big one on March 19th. If I was a betting guy, and I've been known to dabble a little bit, I would say that the Fed's probably going to cut rates in March. It's really early. There's another couple months worth of data to receive between now and then, so a lot can happen. But today, January 31st, I would tell you, yeah, the Fed's probably going to cut rates on March 19th. Somebody take a screen grab of that and remind me if I'm wrong. Markets continue to feel out the new administration. A lot of anxiety, a lot of volatility in the lead up to it. But with Scott Bessent, he's a very moderate pick of the Treasury Secretary. The markets are feeling pretty comfortable right now. Now, there's some outliers, right? New AI out of China can all of a sudden roil the NASDAQ and the tech stocks. Sure, but taking all that out of the picture, as a whole, the markets are fairly comfortable right now. They've gotten used to it. They've gotten used to their new house. They've kind of calmed down a little bit, which is good. Nobody likes volatility, right? As always, inflation and jobs will be critically important. Fed's got a dual mandate. They want to maximize employment and they want to keep prices in check. So moderate inflation and maximize employment. That is their whole goal. Both those data points are going to be very important looking forward. It would only take a soft jobs report, maybe a couple, for the Fed to get a little bit more aggressive with rate cuts. And then lastly, what other surprises are in store? Like I said, it was an eventful month, right? Wasn't necessarily a busy month with regards to the data, but it was a very eventful month. It's going to be very interesting to see what else comes out of the woodwork, what other drama plays out, how do the markets react to all of that. Lots to kind of keep our eyes on. That is it. Thank you all so much. Appreciate you all so much. And I'd say it before, I've said it again. Our love language at Team Staufer is acts of service. We love to serve you. We love to serve your referral partners, your referrals as well. Like, thank you all so very much for all of your assistance. It keeps the lights on. It keeps us doing what we've done. In the mortgage world, a lot of people have gone now, but we've stayed strong. We've been here, and it's all because of you all. So thank you so very much. We appreciate you. Never take it for granted. Thank you all so very much. Have a wonderful weekend. Have a wonderful month, and see you next time. Thanks. Bye.